Welcome in and welcome back. We are here for the 11th, the weekly investor here on the channel. I've got 4 different stories I'm going to be talking about, and then 3 stocks that I'll be watching this week, and I will offer a slight profile on those. The number one thing is that CNBC ran a survey on CFOs, chief financial officers, of large companies, and found that 51% of them believe that the market will fall back below the 19,000, or the Dow will fall back below the 19,000 mark before reaching new highs. This is extremely telling because, number one, that means 49% don't believe that it will. So basically, you've got a 50-50 split. But there's some nuance there, right? This number of CFOs believe that the market will fall back below the March low of 19,000, while and whereas 49% do not. That is not to say that 49% don't believe the market will fall again. And the reason that this is so telling is that so many CFOs, chief financial officers, by the way, people whose job are the numbers coming in and going out of the business, people whose job is not innovation, is not the day-to-day running of the business, whose main job are the numbers themselves. 51% of those, and I didn't catch the number of companies or the market cap of the companies or what industry these companies were in, which, maybe that's a big detail. Especially when you consider that a lot of the devastation we've seen is in the retail and restaurant sector, and a lot of the suffering that's still going on in the stock market is in the financial sector. So there is some nuance missing from the story that I was able to see, but when so many chief financial officers believe that a new low is going to be approached, this is indicative of the actual numbers that are coming into businesses. And that, yes, the numbers actually coming into businesses are just as bad as feared. And not only are they just as bad as feared, they haven't recovered. And not only are they not as bad as feared and they haven't recovered, it's saying that this many chief financial officers understand the bubble in which the market currently resides. So if you go back to 2000, I don't think you would have found 51% of chief financial officers willing to bet that the bubble was as big as the bubble was. Possibly even the same numbers in 2008. What does that really mean? It's hard to say. The market is not 100% a representation of the economy. We have seen that divorce, that schism, become greater and more pronounced over the past 2 months than I think possibly since I've been paying attention to stocks, certainly since I had any idea of anything economy-wise. So I've been interested in this sort of thing going back to middle school, but probably had some grasp on things sophomore year in high school. So you think in 2002, 18 years that I've been watching this, I've never seen things as divorced as they currently are. So it's a little bit reassuring to know that I'm not alone, right? But it will be interesting to see if this is just a sign of investors being more optimistic in the economy's recovery than ever before. The second thing, this is sort of a personal note. I got my so I do my investing through Commerce Brokerage, the bulk of my investing through Commerce Brokerage, and I got my statement that finally shows T-Mobile shares as opposed to Sprint shares. I had 200 Sprint shares. I now have 20 T-Mobile shares. So it was a 10-to-1 reverse split or consolidation. I've never been through this before, and it seems already, so due to a misunderstanding between me and the brokerage guy at Commerce, I ended up in 2012 with 200 shares of Sprint. I wanted $200 worth of Sprint. He bought 200 shares of Sprint. Very large misunderstanding. But at that point, what do you do with it? Do you break your position? No, I just kind of had to sit on it. I mean, I wasn't destitute at any point in time, so I waited for appreciation. And it was like watching paint dry holding Sprint the last better part of a decade. But since it is T-Mobile, there has been some upward trajectory to that stock and those numbers. So it is going to be interesting to me to monitor the way that this thing is going and understand. I don't understand 100% what's going on, to be 100% honest. This is they are the third biggest cell phone coverage provider, cell phone provider. That's why they were able to merge, is because they would not be putting the top two out of place. Basically, they were merging to become number 3, and even then they had to sell some assets. Did T-Mobile, not Sprint. But they were. I invested in them initially because they were a large local play. I don't know. At the time, it made sense to me. Yeah, I don't know. At the time, it was supposed to be $200, so it wouldn't have been that big a deal. But I'm not sure the upside that this company has. So it's going to be interesting for me to dig into the information a little bit further and understand, is this upward trajectory that has been seen by T-Mobile over the past couple weeks, is this because of the 5G revolution, or what's going on there exactly? The third story that I would like to cover today comes from Pfizer, ticker PFE. They dropped 7% after hours on Friday because the company unfortunately realized that their experimental drug Ibrance, I'm not 100% sure how to pronounce it. That's the thing with drugs, right? But it was having no real measurable, possibly causal effect on breast cancer. This is a big deal for the company, for the market, and for people suffering with that affliction. It is unfortunate, but I think that non-business wise, looking at it, every time you understand that one of these drugs does not do what you thought, there are two sides on that. Doing more of X might work better than what we did. Doing more of Y might work better than we did. Watching that move forward, it is interesting to see all of the drugs that are, and obviously I'm not privy to this information, but I keep hearing about different things that are going through testing right now between Pfizer and AbbVie, Merck, things like that. And it is also important to remember that not all of the development in the drug space right now is about COVID-19. They are still cracking away or attempting to crack away at other things that are bothering people and killing people. So it will be interesting to keep an eye on that. And why was that one single prospective drug worth a 7% drop when we found out that it was not working on breast cancer? And is there something else for which that drug can be repurposed? The final sort of story to talk about before getting into individual stocks that I will be watching this week is that CNN Business spoke with a Procter & Gamble senior executive who believes that the consumer spending habits that have been developed and procured and continued over the past 3 months or so are here to stay. They are here for good. They are permanent changes in consumer habits, including online shopping, which is obviously up, including increased spending on health care, such as preventative measures. You're looking at vitamins, you're looking at things like airborne to help your body from getting sicker versus Delsim once you're already battling something. Increased savings rate. This is something that Cathie Wood at ARK Invest has been talking about a lot lately as well. I think she said that 1976 was the last time there was a mentionable increase in savings rate in America. And what we're going through right now has caused I want to say 13% increase in savings rate. That might not be the number at all, and I apologize if it is not. This is just going from memory. I listened to another ARK Invest podcast sort of thing just a couple days ago. But the savings rate is going up amongst Americans, and that's promising. That's a good sign, because around the market, not just around the market, around the economy, the last decade, 2 decades, probably 3 decades, the big worry was something bad is going to happen and everyone is going to go bankrupt. What was the old stat that 50% of Americans can't survive a single tragic event financially? One thing goes wrong and they're toast. So we're seeing a savings rate increase. Now, some of this, especially considering that so many people are unemployed right now, is the fact that many people are making more on unemployment than they were while working, and you've got no place to spend that money. So there's going to be some rebalancing and recombobulation after everything opens up and people are forced back to work, which will be the next couple weeks. I think we're going to see a lot of those numbers kind of truing up. But another thing that the Procter & Gamble senior executive believes is going to be permanent is the consumer being cost conscious. I thought that this was already a thing, considering the massive moves that I have noticed just anecdotally working retail away from name brands and into things that are private label, things that are generic. So it is surprising to me that there was any growth left to be had as far as cost consciousness goes. But it makes me wonder, one thing which was conspicuously absent as far as I'm concerned from that report was the sort of fact that people are stocking up on things as far as moving into semi-prepper territory. Is that going to be more permanent than it was? This is something that I've had an element of prepperdom to my consumer habits, I want to say since I moved out on my own, 18 years old, and I thought, one bad thing happens and I could starve, I've had a little element of that, just because of paranoia more than anything. But it makes me wonder if that element of things is going to be more prevalent moving forward as well. It was, like I say, conspicuously absent from the report that CNN Business ran. It would make sense if it is. I think that there has been an element in the subconscious of the American psyche for a very long time. How often do you hear references to the zombie apocalypse being thrown around? And whenever you have zombie apocalypse references going, someone mentions something about prepping, right? That is sort of the underlying theme to zombie apocalypse type, not just literature, not just movies or TV shows, but also conversation, right? So how often you're ready for the zombie apocalypse, right? Something like that. I think there's going to be a great shift north in prepperdom. And also, the last 10 years or so, maybe a little bit more, couponers have been on the rise. And I've always wondered what those sons of bitches are doing with all that tide. Now they're the ones laughing. Three stocks that I will be watching this week. Number one is NIO, ticker NIO, the Chinese electric vehicle manufacturer. They are currently trading around the $4 mark. The 52-week low is $1.19. The 52-week high is $5.65. It has been an interesting ride the last 9 months or so. This is a stock which was being touted as the Tesla of China. And then China got Tesla. And a lot of the numbers that were being celebrated around the company of NIO turned out to be maybe marshmallows. And a lot of the standard business practices of NIO, one of the things they do is they have a sort of cafe every so often. There's like I don't know what to call it. It's like a storefront for people who drive NIOs, and you can just go and sort of hang out. I'm assuming that's an Asian market thing because there's nothing like that in the United States, right? I don't know if you have. So the sort of the charging apparatus for Tesla superchargers in the United States, I didn't know there were any in Kansas City. I Googled them recently, and yeah, it's just outposts of chargers and a small parking lot. So to think that there is a company blowing all this money on basically equipping a supercharger with a Starbucks, and you get to go in. You know what I mean? So it's an interesting idea. I'm not sure all that the company is getting out of it. But that being said, Tesla is going to dominate China as long as China plays nice with Tesla. We've already seen with California that the minute things sour, Elon Musk is willing to spit in your face and leave, which is a good thing for a CEO to be able to do. But the question with NIO, the real question, is how big will the China market for electric vehicles be? And can NIO perfect their technologies enough that they become a large exporter of electric vehicles? Could we finally see China become a net, not necessarily a net exporter, but an exporter of vehicles? NIO is the one that could make that happen, I think. But one thing to watch is that recently Volkswagen invested $1.1 billion in certain suppliers to NIO, which is always a concern because one of the stories that Tesla has from early on is that I don't remember which CEO it was of one of the major American auto manufacturers. It wasn't Ford. GM tried to approach Tesla's suppliers and just buy all the stuff. So Tesla couldn't make cars. You can't make cars if you don't have driver's seats. You can't make cars if there's no steering wheel. Didn't need the supplies. Tried to choke them out through their suppliers. So it will be interesting to see if that's what Volkswagen is trying to do with NIO. The second stock that I will be watching this week is not exactly a stock, but it is ARK, Cathie Wood's vehicle, ARKK, currently trading in the mid-63s. It has a 52-week low of $33 and a 52-week high of $64.90. So we're already looking at ARK being right around their 52-week high, which is interesting. This is a grab bag of innovation, and the reason I'll be watching it, I simply don't have the bandwidth to keep up with gene editing and 3D printing and all of the myriad of innovations that ARK Invest is keeping up with. And if ARK Invest is more right than wrong, this is going to keep skyrocketing. This is an environment in which the current economy is an environment, and the current global situation is an environment in which innovation plays a winner-take-all game. And I believe you're going to see that. I hate to mention Tesla again, but I love to mention Tesla again. I think you're going to see that with Tesla and auto manufacturers playing out over the next 3 to 5 years, tops. somebody's going to go belly up in the next 2 years. Somebody's going to go belly up in the next 2 years. The next and final stock that I'm going to mention is AT&T, ticker T. I know that a few weeks ago, I said that Chamath had inspired me, and I will not be investing in AT&T. But it's sitting at $31 after a 52-week low of $26 and a 52-week high of about $40. And they're still paying out that 6.7% dividend. You buy it now and you lock it in because the new CEO, John Stankey, says the dividend is well protected, says that's not going anywhere, says it's not shrinking. And HBO Max just launched. But HBO Max did launch to conflicting reports. I've heard a lot of bad things about the launch. I've heard a lot of good things about the launch. So it is going to be interesting to see exactly which side plays out. I have no doubt that in the long run, it's going to be an interesting product, and it's going to get a lot of eyes on it. Especially, and I don't mean to say this as a Marvel fanboy, but if DC ever starts churning out movies at the rate, consistency, and quality to the fan base as does Marvel, that's going to be a cash cow too. So it's going to be interesting to see how that goes moving forward. And I want to hedge my bets. I don't think Netflix is the answer to things. I think Netflix is going to be drowned out. Maybe not drown out. I think they will reach licensing agreements with both Disney and HBO to run their stuff periodically. But I think it's going to be interesting I don't think Netflix is the future. I think these individual streaming services are. But that is all I have for this week. The Weekly Investor number 11. I hope to see you back for week 12 next Monday.